Hello, beautiful people, and welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about Forex market sessions. Okay, so we're going to be breaking down Forex market sessions for those traders who are kind of completely new to the markets, and also the intermediate traders who don't really understand the importance of Forex market sessions. Okay, so without wasting any more of your precious time, let's dive right into it. Okay, so first things first, what are Forex market sessions? Okay, well, in order to understand what Forex market sessions are, you first need to understand, or you first need to know, that the Forex market is open 24 hours, but not all of those 24 hours are equal. Okay, so unlike the stock markets or the other markets, typically, where you are going to have an opening time and a closing time, with the Forex market, because the market is actually global, in the sense that the markets that comprise the currencies which are traded within the Forex markets, when one of those markets or one of the countries is nighttime in that part of the country, in another part of the world it's actually morning, or even it's afternoon or something like that. Okay, so those sessions, as the world goes round and round and round, one session is open and the other is closed. Okay, and because of that, the Forex market is a 24-hour open market. So from the Sunday evenings, that's in the United States time, to Fridays in the evening, most of the other parts of the world, the market is open 247, 245 in this case, since it's all open on Sundays, Saturdays and Sundays. Okay, but the thing is, even though you're going to hear a lot of traders telling you that the market is open 24/7, not all of these hours are equal, just like I said earlier on. And the reason is because there are times when the main sessions, which is what we're going to be talking about today, the main sessions that move prices within the markets are open. And when those sessions are open, most of the time, those are the times when there's going to be a lot of volatility in the market. So most of the movements that you're going to see currency pairs exhibit is usually going to happen during those time periods when these sessions are open, or when there's a session overlap. Okay, so this is basically, the basics of this. Okay, so what are the four major sessions that make up the Forex market? Okay, so when I zoom in on the charts a little bit here, this is one of the indicators I'm using on TradingView to show me the sessions and also the times that they are open. Okay, so it's called the Lux Algo. If you're looking for it, just go to TradingView, click on indicators, and just type Lux Algo sessions, and you'd see the indicator to add it to your chart if you want to. It's free. Okay, so I've set it up in such a way that it's showing me the sessions with the boxes here, showing me the price action that occurred during those sessions. Okay, so first things first, we've got the Sydney session. The Sydney sessions, most traders don't really pay much attention to it, and that's part of the reason for that is because it's one of the major sessions, but it's not actually one of the sessions that really drives volatility or liquidity in the markets. Okay, this comprises of the Australian markets and parts of the world which are around those regions. Okay, so that's where the Sydney market basically operates. After the Sydney session, we've got the Tokyo session. Tokyo is the biggest session in Asia. So you've got Japan, you've got China, and all of those places, and because they're kind of like in one time zone, the Asian market, the biggest session in the Asian market is the Tokyo session. Okay, so what you're going to find is there's going to be a lot of volatility for the Japanese yen pairs, okay, during the Tokyo session. Does this mean that it doesn't move in the other sessions we're going to talk about a little later on? Absolutely not. But since this particular currency pair, in this example, I'm using the JPY, Japanese yen, for this example, since it's native to the Asian region, okay, you're usually going to see the most moves or a lot of volatility for that particular instrument during those sessions, okay, because this is when the businesses and the banks and all of those multinationals that reside in Asia are usually going to be transacting. with the markets, okay? So that's where you're going to see most of the volume coming for the Japanese yen denominated pairs, okay? Now, after the Tokyo session, we've got and again, the Australian session is one of the biggest sessions there are, one of the 4 big sessions there are. But again, I told you after Australia, the Sydney session, we've got the Tokyo session. Tokyo is one of the biggest market sessions you're going to find in Asia, okay? And now moving on, we've got the London session. I'm pretty sure if you've been trading for a while, London and New York session, because you know that, but we're going to be talking about that obviously. They are the biggest sessions there are. Okay, the London session is the biggest session in Europe. Just like when you talk about the Tokyo session, you're talking about, the biggest session in Asia. London session in Europe is the biggest, because this is usually when most of the big cities in Europe are going to be up and awake, up and about, and transacting with the markets, okay, interacting with the markets and making all those currency exchange transactions for their multinationals and all of those things, okay. So usually pairs like the Euro USD or the GBP USD or all of those USD that all of those currency pairs that have European currencies in them are going to see the most volatility and liquidity during these times. And last but not least, we've got the New York session. And this is the biggest session in the Americas. Okay, so the New York session, again, is the biggest session in the Americas, because when New York is in full swing, okay, when it's morning in New York and the news events are coming out from the for example, let's say from the Feds and most of the government bodies that really push this economic indicators and whatnot, economic reports are usually going to be open at around that time. Okay, now these sessions, what you're going to find is they don't exist in isolation. What I mean is, you're really going to find a session where that session is only going to be the one open from its beginning to its end. What you're going to find is there are usually going to be times when 2 or more than 2 trading sessions are going to overlap with each other. And when 2 or more sessions, major sessions, overlap with each other, those are usually the times when you're going to see the most volatility in the market, especially if those sessions are the big sessions, okay? So as you can see from the rectangle on my chart here, you can see that this yellow box, this light yellow box, is showing us the moment in time where the Sydney session began, and where you'd see its last shade, kind of somewhere around here, is usually showing you the last candle or the candle of the moment when that particular session closed. Okay, but you can see between the session, the moment when the session opened and when it closed, there was a point in time where Tokyo opened, and so there was an overlap between the Tokyo session and the Sydney session. Pay attention to how the price action was before the overlap occurred between the Sydney session and the Tokyo session. So when I zoom in on the charts a little bit, you'll notice that before the Tokyo session opened, when it was only the Sydney session that was open, the price action was pretty much very small. When I zoom out a little bit and I pick this ruler tool, you'd notice that this was the high of the, the Sydney session, somewhere around here. And then this was the low of that session before the Tokyo session opened. So this was kind of like only around a 32 pips move, or let's just round it to, let's say, give or take 35 to 40 pips. This was the only price action that occurred when it was only the session, Sydney session, that was open. But notice what happened immediately after Tokyo opened. Right after Tokyo opened, the volatility spiked up significantly, and this is partly the reason behind this is because the Tokyo session is a very big session, and coupled with the fact that the currency pair we are looking at right now is a currency pair which has the Japanese yen denominated as one of its currencies. So we've got the base currency as the USD and the quote currency as the Japanese yen. And if you remember what I told you, most of the times you'd notice that a currency that is domiciled to one of the regions that is open is usually going to see more volatility at the moment when that session is open. Okay, so what happened here is you notice that when the Tokyo session opened and there was an overlap between the Tokyo and Sydney session, and we're also looking at the USD JPY currency pair, the volatility for that pair spiked up significantly. And so we went from having barely a 40 to 35 pips range to now the currency pair before the end of that session overlap between Tokyo and Sydney, having a move that had a range of around 112, let's just say 115 pips, give or take. Okay, so how do you use this information to your advantage? Okay, if you're someone who trades multiple currency pairs, you'd usually want to trade a currency pair at the moment when the session for that currency pair, or the session which that currency pair, one of the currencies in the currency pair is domiciled. You want to trade that particular currency pair when one of those sessions is active. Okay, so in this case, if you are trading a Japanese yen currency pair, maybe the USD JPY, maybe the GBP JPY, or whatever the case might be, you either want to trade it when the Tokyo session is open, or it's even overlapping with a European session, or you want to trade it when one of the European sessions is open, or two or more sessions which include the European session are actually overlapping. So let me give you an example. Right now, let's say this is the USD JPY currency pair. If you want to trade the USD JPY currency pair, during times, remember I told you that even though the Forex market is open 24 hours, not all of those 24 hours are equal. Some hours are going to see much more spikes, much more increase in volatility and liquidity than other hours, when most of the sessions that have this currency as domiciled as one of the currencies that they use is not open. Okay, so if, for example, you've made up your mind that you want to trade the USD JPY currency pair, the best times to trade it is, one, to trade it when Tokyo session is active. And not only that, considerably, if you can trade it when Tokyo session is overlapping with Sydney session, that's even better, because you're just going to have much more volatility in the market. That's one of the times you can trade it. The other time is for you to trade it when the New York session is open. Why did I say that? The reason why I said that is because the United States dollar, as you obviously know, is the currency of United States of America. And so when you have the US session, New York session in this case, when it's open, the US dollar is going to see most of its volatility during those times. So it's either you trade this currency pair when Tokyo session is active or overlapping with Sydney session, or you can trade it. The second best time to trade it is when the New York session is open, or it's even overlapping with the London session, because that's where you're going to see the most moves. Okay, so with this particular example, this is just one day that we're using to make an example here. And you can see that when it was only the Tokyo Sydney session that was active, the move wasn't all that much. Okay, but then immediately the Tokyo session overlapped with the Sydney session, you can see that there was a significant boost in volatility. And not only that, the second time when we had a overlap between the London session and the New York session, and since this currency pair has the USD in it, which is the main currency of the United States of America, you can see that we had another big push in volatility when those sessions were overlapping. Okay, so this is, I just gave you an example using the USD JPY currency pair, but you can extrapolate this information to other pairs, considering which which regions the currency that makes up the pair is domiciled in, and trade accordingly. For example, if you were to trade something like the NZ, let's say NZD USD, okay, the NZD is obviously the New Zealand dollar, okay, and then we've got the USD. New Zealand dollar, like I told you earlier on, New Zealand in this case is one of the sessions that is in and around the Sydney session. It's one of those sessions that you have New Zealand, Australia, and all of those regions, which they're most active when that particular moment is, the session is active, the Sydney session in this case. So one of the two best times to trade it is when the Sydney session is active. Or the second best time to trade it is to trade it when the New York session is active. Why? Because the first time I said, which is the best time to trade it, was when the Sydney session is active, because that's when Australia, New Zealand, and all those down under countries are usually going to be open and active, and that's when you're going to see the most volatility in their pairs. But if you don't get the chance to trade that, maybe because your time zone, when it's morning there or it's afternoon there, it's midnight in your country, and so you can't just stay up all night just to trade. Okay, you've got to have enough sleep and everything like that. So in this case, the second best time for you to trade it would be to trade it when the United States session, the biggest session, New York session, is open, and so you're also going to see moves in that currency pair. So you can extrapolate this to other pairs and then, react accordingly. Okay, so moving on. So what are some common mistakes you need to avoid when you're trading based on Forex sessions? Okay, one of them is, like I told you, not even though the Forex hours is open 24/7, not all of those hours are equal. And so you don't want to be trading at random hours just because a session is open, just because the market is open, not necessarily any session, but just because the market is open. So for example, let's say you're in the time zone of GMT +1, for example, and you happen to be up around 10 in the night or 11 in the night. And so you decided, because the Forex market is a 24-hour market, it's open 24 hours, you just want to trade at that particular moment in time. That would not be quite a good idea. And one of the reasons for that is because at that moment in time, almost all of the major sessions are closed. Okay? So the New York session, even if it's not closed, it's winding down considerably. Okay? And the Tokyo session is not open yet. Maybe you've got a little bit of move in the Sydney session, but European sessions are also not open at that time. And so during those time periods, the market is usually going to be very, very quiet. Okay? If you dropped a pin, you could almost hear it by that time. Okay? So these are the times that are characterized by things like this, very tight ranges. Price not moving anywhere significantly. And since trading the Forex market, for you to make money trading the Forex market, you need volatility. You need price to move in one direction, more than another direction. For example, if you were to place a buy trade, you'd want price to go higher than where you bought so that you make a profit. Or even if it doesn't go in the direction of where you bought, at least move against you a little bit to take you out with a stop loss. But if there's no volatility in the market, price is almost going to be stuck in one place. It's not going to go to hit your profit target and take you out of the trade with a profit, or even move to your stop loss and take you out of the market with a loss. On the contrary, what you're even going to find is when you're trading within those hours, which are usually known as the rollover hours, spreads are going to be wide as what you don't even know. Okay? If on a regular day when the markets are active, the spreads on the Euro USD or the GBP USD currency pair, for example, is less than a pip. When it's around those rollover periods, it's not uncommon for you to see spreads upward of 10 pips or even 20 pips, because most of the times the volatility in the market is very, very thin at those hours. So you want to stay away from trading those type of hours when there's very, very little volatility and liquidity in the market. Okay? So don't just say, because the market is open at that time, I can trade it, just like I would trade at normal other regular hours. You want to trade when the market is most active, because not only are you going to be getting the best spreads and commissions and all of those ways that that brokers are going to charge you, but you're also going to get the most moves in the market. Secondly, you don't want to be over trading during low liquidity sessions. So for example, I told you that even though Sydney is one of the 4 major sessions there are, it's not on a scale of 1 to 10, okay? It's, let's say, kind of like around hovering between 4 and 6 in terms of volatility, because it's not as volatile as the other big sessions like the Tokyo session or the London session or the New York session. Okay? And so when it's a low volatility session like Sydney, for example, if you're not trading pairs or currencies that are domiciled within regions that are usually going to get huge surges due to economic reports being released at those times from countries like Australia or New Zealand or all those other countries like that, you really don't want to be trading at those times, because there's going to be very low liquidity during those particular sessions. Okay, so you don't want to be over trading then, because when you do that, you're only going to be exposing yourselves to, very high rollover spreads and all of those expenses and costs for a market that is barely going to move to even hit your stop loss or take profit. You don't want to be doing that. And you also want to factor in the volatility of the pair that you're trading at the time you're trading it, because you want movement in the market. If you buy or sell a currency pair and it just stays stuck, you're not going to make any money. And in trading, we want volatility. We want price needs to move for us to make money. And so we want to trade when there's a higher chance of that happening. Okay? One important thing that's worthy of note is the fact that not all trading styles suit all trading sessions. So for example, like I told you, let's assume you're a scalper. Scalpers usually want to open and close trades within a very short period of time. Most of the times they're trading with high position sizes, very large position sizes, just because they want to catch a pip or two, or very little amount of pips to get their profits, and they're out of the market. Now the thing that you'd find is, if for example a scalper was to try to trade when the market is very quiet, there's not enough volatility in the market. And don't forget, I told you that most of the times, if you're even trading at hours where the volatility is very low, because most of those major sessions are closed, you're going to get hit with very large spreads. So for a scalper, this could be detrimental, because a scalper could be trading with, very huge lot size, where even if his spread was just like 1 pip, that would be more than 20% of the profits that he's going to be making from that trading position. And so when a scalper who doesn't know how the market works tries to trade during rollover periods, for example, and he's expecting a spread of, less than 1 pip, for him to be able to get that 2 or 3 pip move and just bank his profits and call it a day, when he opens the trade at that moment and realizes that because it's the rollover period, he's getting hit by a spread of like 10 or 20 pips, that could easily blow out his trading accounts. And so you need to understand what type of trader you are and when it is best for you to trade. For a scalper, trading during low volatility periods is a complete no-no. A scalper who wants to get in and out of the markets very fast needs volatility to be able to do that. And to do that, he's going to need to consider which currency pair he's trading and which time period or market session that currency pair tends to get the highest volatility, so that he's going to not only get the best spreads, but he's also going to get the moves that he needs to either quickly make his profits or quickly cut his losses and call it a day. Okay? And apart from that, there's something that a lot of traders I noticed don't really understand about trading sessions. Okay? You see, I've been trading for over 10 years in the market. And one thing I've noticed is that I am a trader who doesn't like staying in front of this, being glued in front of my screen, waiting for trade setups, managing them. And, I got into trading to get freedom, not to be enslaved to the charts and, just replacing it with my regular 9 to 5. Okay? So what you'd find is, most traders, maybe because they don't know any better, or maybe because that's just, the temperament or style of trading that suits them, some don't even know otherwise. Some traders would just be, I want to trade the London session, I want to trade this session. They'll be glued to their screen, watching every single move in the market. But for me personally, sessions don't really affect me all that much. Why do I say this? And the reason why I say this is because I'm not a scalper and I'm not a day trader, but a swing trader. When you're swing trading, most of the times, if it's not to just time your entries, okay, so that, for example, swing traders, like usually hold trading positions open from anywhere from a couple of hours to, a couple of days. Okay, so for a swing trader, most of the time, it's not really going to matter all that much which trading session you got your trading signal from and when you place the trade or all of that, except if you're just timing your entries so that you don't get hit by all those rollover spreads and you want to get into the market when there's the most volatility and all of that. But for a trader who usually opens and closes his trades within a single trading day, then it's going to be absolutely important that he places those trades when there's volatility in the market. But for a swing, and that's the reason for that is because he's opening and closing his trade most of the times within that same day. But for a swing trader, it doesn't really matter because his trade is usually on average going to last more than a day. And so which session he opens or whether he gets his trades gets triggered by placing pending orders or all of that is usually going to matter not all that much. Okay, and so you need to understand what type of trader you are, what's your temperament, and which of these sessions or which of these trading styles suits your personality, and proceed accordingly. And last but not least, we've got the lifestyle, time zone, and personality matter that you need to consider. What do I mean? If you're, for example, living in Africa, okay, and you decide that you don't want to be trading at any other session, during any other session, or you've created a trading strategy that you've backtested, for tested, and proven that that trading strategy is actually profitable, okay, and that's what you want to use to trade the markets going forward. And so what trading session am I talking about now? As for this example, let's say you decide that the trading session that you want to be trading during is the Sydney session, and you happen to be living in Africa, for example. Okay, now the what do you call it? The constraints that you're going to face is the fact that most of the times when the Asian session, when the Sydney session is going to be open, okay, that's going to be very, very late in the night in Africa. Like I told you, anything from 10 to 11 o'clock, and to 12 o'clock, when most of the times, or 1 o'clock, when the Tokyo session is going to be open, and there's going to be that overlap between Sydney and Tokyo, you are going to be fast asleep. And so even though your trading strategy on paper shows that it's profitable, when it comes time to execute it flawlessly, which is what you're supposed to be doing for you to become profitable, you might have difficulty doing that, not because of any fault of your own, not because you saw the signal and deliberately refused to take it because of some emotional baggage or anything like that. No, but maybe because you were just fast asleep when the signal occurred. And so if you don't factor in this type of circumstances, okay, when you go about planning how to trade the markets with your chosen trading strategy or approach or anything like that, then you're going to find it difficult to execute flawlessly. And so when you're creating a trading strategy, or when you're choosing to adopt a trading strategy to trade with, you should also factor in the lifestyle implication of that trading strategy. If you're somebody who lives in Africa, for example, try to find a trading strategy that would work well in tandem with the sessions, like the European sessions, where we have the London session, or the New York session, where when the London session, obviously, because in Africa, when it's morning in London, it's going to be morning in, for example, Nigeria. And when it's morning in New York, it's going to be early afternoon in Nigeria. And so you could trade, because of the way you're situated geographically, you could take advantage of the European session, London session here, and New York session, and even their overlap. And those two sessions are kind of like the biggest sessions around the world for traders to trade with. So when you're creating a trading strategy or creating your trading plan, take time to factor in this situation, so that you're not going to end up with a trading strategy that works when you test it on paper, but when you try to execute it, you fail miserably, not because you're not taking the strategy serious, but because most of the times when you're going to be seeing the signals of that trading strategy, you're not even awake to take action. Okay, so you need to consider this. Okay, now before we quickly wrap up the class, I'd like to use this opportunity to let you guys know that we've got a suite of bots, which is the ITU Forex bots, expert advisors, which are designed to help you earn while you're learning how to trade. So we've got the SBT, the ABT, the Goldmine. All of these robots are designed to help you look for low risk, high probability trading opportunities, place those trades on your behalf. If you follow our risk recommendations, they will place those trades, not only finding low risk, high probability trading opportunities, but they're also going to place those trades with proper risk management to keep you covered. Okay, so if you're interested, please leave a comment in the questions section or anything like that, or reach out to us on our social handles, and we'll be more than happy to assist you set everything up step by step and take advantage of this opportunity while it lasts. So I sincerely thank you for taking time out of your busy schedules to come to these classes, and to also be as dedicated to honing your craft of trading, okay, as you have. and I sincerely appreciate it. I hope you got a ton of value from the class, and I look forward to seeing you guys in next week's edition. In the meantime, go out there and crush the markets, and please don't just come watch the videos and just go. Come watch the videos, but also take notes, and then go out there and what you've learned, put them into practice. If not, you're just going to be wasting your time, and that would be a shame, because you're supposed to be improving as a trader. Okay, so once again, thank you, and I look forward to seeing you guys in next week's edition of the class. In the meantime, go out there and crush the markets, and God bless you all. Cheers.